And the bank will say, yeah, we've got SBA loans. We can get you some working capital. We can finance those trucks and everything. Oh, by the way, we've got these things called blanket liens. And a blanket lien means if you default on your payment for the SBA loan, we have the right to go in and seize any asset across your business. So I know you only paid for the typewriters, but I'm going to go and take those nice cases over there, and I'm going to sell them below market value and to recoup my expenses. So the type of money you bring in is going to determine how liquid your business is, or how much wherewithal you have to go and finance other things you need to finance, right? And so capital acquisition strategy is the appropriate financing of the projects that you're taking along that trajectory. When you're up and running and you're in the mid-market, and you've done a bunch of loans with American Express or some of these other capital houses that take money out of your account every day and every week, you want to get rid of that because it's just too taxing. You can't possibly make a profit fast enough to keep up with these guys. And people sign these notes all the time. They're desperate for money, but they don't understand the capital stack well enough to say, you know, you could have gone to a private lender and gotten 9% on that money instead of paying 18%. You know, so what I do as a strategist there is I come in and I say, let me take a look at what kind of debt you've got and the interest that you're paying. I'm going to look at your financials. I'm going to determine your profits, your profit margin and your operational margin. And then I'm going to make some recommendations on how we can swap out this debt. Okay? And especially as it relates to what they call current portion of long-term debt. Current portion of long-term debt is how much money do you owe this year? You know, so what are you up against? You know, what's the real challenge here? And being able to navigate a business in a way that produces more margin or profit than it does interest or what they call cost of capital. So cost of capital relates to the capital stack. And at every stage along the way, you've got a cost of capital. What do you think's more expensive? If I'm a private equity finance manager and I say, I'm going to give you $50,000, but I want 30% of your company, or I'm a banker and I'll give you $50,000 and I'm going to charge you 30% on the money. Which one is more expensive and why?
I prefer second one.
What?
Second one is better.
Depends on the return, right?
Yeah, it does depend on the return, and you're wrong. It's not just the second one. It was kind of a trick question because it sounds like it's really, who's going to pay 30% on a bank loan, right? But when you consider yourself as a thriving, successful entity, and someone owns 30% of your company, and so before you ever achieve your exit or the real money that's going to be derived out of your business, you've got to pay that equity partner off, don't you? If the business is going to be bought. Whereas a debt, I can swap out. I can pay off, and then I'm free and clear. So ultimately, the cost of capital relates to liquidity and how liquid you are as a business. And what are the best businesses? The businesses that are most liquid. If you're debt-free and you're making bank, whoa, impressive. But if you're leveraged in the cost of your capital, your debt is sinking you such that you can't even make a profit, well, then we got a different story. Do you know what I mean? And so capital stack isn't an easy thing to talk about, but it is something to talk about. It is something to understand. Thank you for the question. If you want, we can have coffee and talk more about that. One more question, or?